Now we're going to look at what's happening in the U.S. and we're going to start with some of the key indicators that the Fed is using, but we're also want to look at other pieces that are happening on the regional Fed side, because a lot of slowdowns have continued, especially on the Philly Fed side, which is an important place to start. So when you look at market pricing for the Fed funds rate, as we were saying, 50 basis points makes a lot of sense. We that's where we were expecting at this point. We do think that there's either another 50 next year or 25 and 25. But when Bullard comes out and says that he would only even entertain slowing down and only after we hit 5%, 5.25%, which is exactly what we've been saying. So we still think that 5% is the minimum, which is why getting 50 basis points here puts us at 4.5, which then the next 50 basis points could come 25, all 50 at once. But there's going to be something there to get us to that level. And the two yield curves watched closely by the Fed flash recession warnings, which is the 18-month, 3-month, and then the 10-year, 3-month. And it's all of it, again, is showing you all of the risks that are out there. We see it, everybody sees it, and that's something that I think is only going to get worse. But that has sent the put-call ratio spike to the highest level since 1997. And we all know that when this happens, there is usually a rally. So when you look at the extremes, is there a likely rally that could be built on the back end of this? Absolutely. People get too bearish. They extend themselves to the downside, buy too much downside production. Then the brokers have to go out and cover themselves. Increases the amount of volume out there. So again, that's why this is something that could flash a near-term bottom that could send us up higher. But we've already had a massive move up. So was that because of this? Was that something where now we're fully covered and the move lower can continue? That is going to be something that we need to watch as we go into not only the end of this week, but into next. And it's not surprising that everybody's worried about inflation. So inflation is as the most important problem facing the U.S. Polls from Gallup show 20% of respondents say inflation is the most important problem facing the country, which is the greatest share in 40 years. So the inflation side is going to continue to be the driving factor when you look at what the Fed is going to address, which is why we do believe to see this come to pass, and we do see rates going up. This isn't going to stop, because if people are looking at this and saying, look, I'm scared about inflation, well, then the Fed has the freedom to come out and say, well, we're going to attack it. We're going to come after it, and that's why we have to go higher. So they just get more support for those movements. And then this just looks at the extension and the U.S. bond curve. But because of the inflation, the view that inflation is slowing, that has cooled off some of the back end side. But realistically, this just shows you a recession is imminent. And that's one of the key pieces. Now, the Philly Fed index faltered in November to a contractionary 19.4 from an already bleak 8.7 reading in October. The data goes back to 1968. In expansions, this index averages 13.3. In recessions, it averages negative 18.3, and we're now at negative 19.4. So this is showing that the Fed can't really stop because inflation is still there. You still have jobs that are elevated enough to the point that they can continue, and retail sales were, when you adjust for inflation, were flat. So the consumer still has some capacity to take more rates to the upside, which is why we don't see them stopping. The lending standards continue to tighten for large, medium companies. Net percent of respondents in Senior Loan Office Opinion Survey on bank lending practices tightening standards starting to look recessionary. Real GDP, financial conditions. Financial conditions are tightening. Obviously, there are different sides to this. But real GDP, and this comes back to what we talked about in segment 1, when you look at credit impulses, this is showing you credit impulses slowing, which is going to pull back on underlying GDP flows. Then you look at the year-over-year change in bank deposits is negative for the first time since the mid-1990s because deposits are coming down. People are just don't have the money to put into the bank, because they're financing things, because credit cards, because of costs, because of inflation. So even though things look stable on the retail side, this is showing you that, are they really that stable, or are people just, taking money out from the banks and deposits are going down? Cumulative change in average private sector borrowing costs. When you look at what is happening right now, this is the fastest rate of tightening in private sector borrowing costs ever. This is outpacing 1977. So you're seeing this extreme, and it's actually outpacing what the Fed is indicating. And it's because there's so much liquidity out there, there's so much fear, that banks are just pulling back as hard as they can to try to slow down some of these movements. Then when you look at 5 straight monthly contractions for PPI manufacturing materials and components, a streak not seen since February to June of 2020. But look at the level that we're starting at. And again, as we've said, the pace of inflation is going to slow. We can't, especially when you look year over year, it has to change. Like the comps are so hard, but look at where we're slowing from. Like everyone's like, oh, we're slowing. It's like, but from where? Are we back to normal? No, we're going up at a slower pace. Nobody's seeing deflation. How many people watching this can say, oh, yeah, I've seen my prices actually go down? No, it's just instead of them going up $10 across 6 months, they went up $2. But they're still going up, which you're still trying to recoup, which you're still trying to pass through. And that's the other underlying problems that we continue to see. Then when we look at some of the leading indicators, big improvement for November, Empire Manufacturing was up to 5.5 versus the estimate of -6. However, new orders fell into contraction with prices moved higher, and the outlook is the worst it has ever been. So you're looking at this and you're essentially seeing a blip because, okay, well, November Empire Manufacturing, you're in November, you're trying to get things done for the holidays, but essentially the outlook is like, look, things are going to get really bad. And that is a bigger concern as we look out and go forward. Plus, you have inventories rose, shipments, employment, and work week, but look at prices. Look at head prices. As we said, you were going to have a normalization of pricing. Things were going to come down, but then they were going to bounce. And then you were going to see them rise just at a slower rate. And there we are. We're still in expansion right now. The expectation is for a little bit of a reduction in 6 months, but it's starting to bounce because diesel prices bounce. Supply chain costs, while shipping has come down, where's steel? Where's labor? Where are wage costs? And that's where you're starting to see some of this remain sticky. Then you look at the Empire State, so the manufacturing, it's still trending down. It's a higher, but it's a lower high. Is it going to come back down? Well, look at new orders. New orders are negative. New orders, leading indicator, showing you your direction. Prices paid back into expansion. Number of employees picked up a bit, which if you think, well, if manufacturing is picking up, you need more employees to finish off some of these activities, so that makes sense. But then look forward. Expected business conditions. Outlook for new orders from Empire Manufacturing PMI has fallen to the lowest, most negative in history of the survey, as you can see with expected new orders and expected business conditions. So you're at extremes now where the contraction is accelerating and getting even more problematic than before. Then when you look at U.S. Empire State Manufacturing, expected shipments, worst ever. And then when you look at ISM, short cycle lead indicators, well, Empire State is telling you it's going forward, it's going to get worse. Philadelphia is at one of the lowest it's been in a long time, fully in contraction. Short cycle lead index is down. ISM, well, it's going further into contraction. Then when you look at the Philly Fed, November PMI in Philly fell further into recessionary territory, came in at negative 19.4 versus the estimate of 6. New orders and inventories fell further into contraction. Prices paid eased a touch, but still in expansion. Employment fell sharply to the lowest since June 2020. And that's the counter piece, because when you look at the trend, even in Empire, it bounced, but at a low to a newer low, which is a lower high, which again speaks to some of the problems coming up. October PPI inflation came in at positive 0.2 versus the estimate of 0.4. Again, still up, a slower rate, but still higher. Core came in at 0% versus the estimate of up 0.3. So positive, but not deflationary. And when you look at some of the prices paid, you look at some of the leading indicators, you're getting some support, some bounce there. October PPI inflation came in cooler at 8% year over year versus the estimate of 8.3%. But look at the high that you're at. Look at core. Core came in at 6.7% versus the estimate of 7.2. So you're still seeing some of the slowdown, but your year over year comps are getting easier because things were so excessive previously. But month over month, you're still ticking along at a rate where you're still not in front of inflation. You're still seeing costs go up. You're still seeing this come through. And there's a certain amount of lag, but that's what the Fed is trying to get in front of, which is why rates are going up. PPI goods prices across the supply chain. PPI unprocessed came down while PPI finished continues to go up, which is the unprocessed, as you can see in August, was massive. So you're going to process it, you're going to get it into its final form, and now you're going to have your finished product, and you're going to try to recoup some of those costs. But unprocessed, you're seeing that has come down, which will filter through the system and will start to be a little bit more a benefit to you when you think about some of the holistic input costs that will help bring PPI prices lower, but it takes time. And there's a lot of things that can happen in between that. We continue to see supply shortfalls on commodities even as demand comes down. So some of these different interactions are going to weigh on some of the underlying pieces. Empire Manufacturing future new orders in recession territory. That's the latest estimate. And you can go back through 2002, lowest ever. And that's where we see a lot of these perpetual issues that continue to crop up. Then you take residential energy prices continue to soar, adding to consumer stress. Average price in the U.S. has risen by more than 14% year to date. When you look at the U.S. average residential electricity prices, but look at the trend. The trend has been higher. It's been slower, but now we're going parabolic because you're taking more and more capacity down. Technically, we should see manufacturing is in contraction. Services have slowed. We should be seeing this come down, but it's not. It's going up. And this is one of those big concerns that we've been trying to highlight as issues that continue to roll through. Some of the problems all the way, components in general, so that we can see, what is going to happen. How is this going to impact things going forward? Then when we look at the Goldman Sachs U.S. financial conditions are coming off one of their best, easiest weekly changes in history. Moves these days reminiscent of prior recessions because you get a lot of volatility, a lot of movement, which is common. It's not surprising. But that's why when we look going forward, we want to break down PPI a bit more and look, because it's going to be important for the consumer, and how is that going to impact the consumer and purchasing power as we go through, as well as look at retail sales in the next segment.